Hello and a warm welcome. You've joined us in Market Fatafat right here on ET Now. I'm Ashesha Atvaryu. With me is Ankita Saxena. This is a show where we discuss all the stocks that are buzzing in trade. But before we do that, let's put the spotlight on PFC because the company is all set to launch the public issue of non-convertible debentures worth about 5,000 crore rupees. This, remember, is the largest retail debt sale in the last 8 years. On the back of this, we caught up with Parminder Chopra, CMD of PFC, to understand the power financiers fund utilization and growth plans. Let's go across and listen into an excerpt.
From this public issue of bonds, the usage shall be 75% towards our main business, that is on lending for the power and infrastructure sector, and then refinancing of the loans and debt servicing, and balance 25% will be the general miscellaneous corporate purposes.
Right. As you mentioned about this particular issue, I want to understand overall strategy of the company of borrowing mix. What are your plans?
On an overall basis, if you see, PFC has been borrowing from the domestic as well as from the international market. And we tap funds through primarily from the private placement of bonds, term loans, and short-term loans, etc. From the international market also, the bonds and the term loans are the primary sources. Generally, we don't go for the public issuance of bonds, but this time we thought that again, this is the third in the series. Earlier we have 2 public issue of taxable bonds. This is the third one. And the philosophy behind this is that to make the general public and every citizen of the country a part of the India's growth story, and especially for the power sector.
Definitely, and who can forget PFC for that? Now, overall, when you are saying that you're coming up with the bonds, the cost scenario is interesting with the Reserve Bank of India already lowering the rates last time, and expectations are there might be one more cut. How do you manage cost of funds in this scenario?
See, generally it's a mix of borrowing that we manage the cost of funds. But if you talk of this issuance, definitely you might have seen the yields are slightly higher because we wanted to give the benefit to the retail investor and incentivize them for the main objective of the purpose.
If I remember correctly, regarding cost of funds per se, it was around 7.4%. Now, overall, where do you want to end the year in terms of your cost and also managing the cost to income ratio?
See, with respect to the cost, being an NBFC, we don't have any concessional cost of funding. And the other thing is that we raise from the market. And since we are funding for the project financing and for the longer tenor, which is around 15 to 20 years, we also source our funds for the longer tenor. And that longer tenor gives, only the bond market gives that longer tenor. So our major cost, around 60%, is on fixed rate. Right. So if you see PFC, even in the history, our transition to the reducing cost scenario or the increasing cost scenario, in both the cases, it's a gradual shift. So it takes time. So I don't think that there is going to be a significant impact on the overall cost of borrowing when we end our year in the March 2026. Maybe gradually we are able to translate that into the overall cost of borrowing.
And similarly, protecting your spreads, do you think it is going to be a challenge?
Definitely in the competitive scenario, it's going to be the challenge, but we are trying our best to maintain the guidance which we have given to our investors.
Right. Talking about the power sector per se, there are policy shifts which are also expected with the bill which is pending in Parliament. What is your expectation on that front? And overall, your focus towards renewable sector?
PFC has been the largest lender for the renewable sector. We have supported around 65 gigawatt of capacity, which is, I think, almost one third of the capacity till now. So we have been seeing our shift from the thermal generation to the renewable portfolio. So we are very optimistic about the growth of the renewable sector in the overall power sector, and especially for the energy transition. You see that every day, I think, power sector is the fast evolving sector, and we have been seeing every day from the basic solar and wind, now we are targeting hybrid, then we are targeting round the clock power, then now the shift is coming to the storage. So I think in today's date, the storage is going to be the integral part of the renewable and will address the intermittent nature of the sector. So we are seeing every day a new thing and in the financing of the power sector.
Right. The tenure of the bond issue also, which you have come up 10 to 15 years, it is also matching with the asset and liabilities?
Right. Our average life of the asset is around 6.5 years, and average life of the liabilities is around 5 years. So we are trying to match to the extent possible.
Right. Budget is around the corner and the dates have now been decided. What are your expectations this time from budget session and the budget document?
See, as a NBFC and funding for the infrastructure sector, our wish list would be to have cheaper source of financing so that we can also lend at a competitive rate, and the cheaper cost translate into the cheaper electricity rate for each and every citizen of the country.
Okay, so that's the word coming in.